Welcome to the Deep Dive, brought to you exclusively on the One More Bitcoin channel. We're here to take the research you've shared, cut right through the noise, and pull out the insights you really need to know.
And today's deep dive is, I think it's a critical one. We're looking at the projected future of Ethereum, focusing specifically on the 2026 outlook.
And to do that, we're digging into one source.
That's right. We are exclusively analyzing the findings from the One More Money blog, specifically their article, Ethereum 2026 Update and Outlook, Institutional Adoption, Scalability Roadmap, and Investment Thesis.
So our mission is pretty clear. Let's unpack this evolution. How does Ethereum go from being, a general-purpose blockchain to what this research is calling the settlement layer for Silicon and Wall Street?
And that name, that's not just hyperbole. It really defines the central thesis of the whole report. The analysis highlights that Ethereum is moving past its decentralized computer phase, a transition that, it really kicked off with the merge. And now it's cementing itself as let's call it a scalable settlement layer with very strong institutional utility.
That feels like a huge strategic pivot. And if we're looking towards 2026, the research points to two main drivers for this. First, the technical evolution, so throughput, cost, decentralization. And second, this massive wave of institutional adoption.
And reconciling those two is the really hard part. The early narratives were all about dApp experimentation, kind of a Wild West.
Right.
The 2026 vision is completely different. It's about balancing high-security settlement with enterprise performance, all while keeping that decentralization robust. It's a shift from thinking of it as digital oil to more like an industrial, reliable financial infrastructure.
Okay, let's start with the technical side then, because that reliability, it has to start with the core protocol. The research talks about a shift toward biannual iterative hard forks, so smaller, more predictable upgrades.
Which is a huge signal of maturity. Predictability is completely non-negotiable for enterprise integration.
They can't build on a moving target.
Exactly. Institutions can't build on a platform that might just totally change its architecture overnight. And the two big forks slated for 2026 reflect this perfectly.
So let's get into the first one, anticipated for the first half of 2026, Glamsterdam. What are the key parts here that would actually matter to, say, Wall Street?
Well, the two biggest components are performance and verified transaction neutrality. First up is something called Enshrined Proposer-Builder Separation, or EPBS.
EPBS, okay.
It formally separates the role of who builds a block from who proposes it. It prevents collusion to, manipulate transaction inclusion for profit.
Hold on a second. Why does EPBS matter to a big investment bank? They don't care about the internal politics of the protocol, do they?
Well, they absolutely care about the integrity of the data stream. EPBS is what mitigates the risk of MEV, or maximal extractable value, at the base layer.
I see.
So for a big financial player settling millions in tokenized assets, they need to know the transaction ordering is neutral and can be verified. This separation reduces centralization risk and ensures the network is a reliable, transparent clearinghouse. That is just paramount for institutional trust.
That makes perfect sense. And alongside EPBS, there's also parallel transaction processing and a pretty substantial gas limit expansion. We're talking a potential jump from around 60 million to 200 million units.
Yeah, the One More Money blog points out this could get us to maybe 10,000 transactions per second on the base layer alone.
Wow.
Just to put that in perspective, a few years ago, getting to even 100 TPS on the base layer was seen as a huge goal. This is a structural leap.
Oh, wait, doesn't raising the gas limit that much, tripling it, increase the hardware load for running a node? Couldn't that push out smaller validators and actually centralize the network?
That is the exact balancing act. You're spot on. Increasing the speed on L1 creates this problem called state bloat. The database just grows too fast.
Right.
And that is precisely why the second major upgrade, Hegota, which is planned for later in 2026, is so critical. If Glamsterdam is about speed, Hegota is all about protecting decentralization from that growth.
So Hegota is focused on node efficiency. How does it tackle that growing state?
It introduces something called Verkle Trees. They're a replacement for the older Merkle Patricia trees.
Okay.
The best way to think about it is like upgrading the network's entire filing system. Verkle trees are a much more compact way to represent the state. So by drastically lowering the storage a full node needs, it keeps it accessible for more people.
So Verkle trees are what lets an average person still run a validator? Even as the network's throughput just explodes, it keeps it decentralized.
Precisely. And lowering the storage requirements then opens the door for stateless client support, which lets nodes verify blocks with very little data. And then there's an optional state and history expiry feature to archive old data.
So these aren't just technical tweaks.
Not at all. They are core security features. They preserve the decentralized guarantee that these institutions are ultimately buying into.
So the L1 roadmap is the foundation for secure, high-performance settlement. Now, what are the layer 2s building on top of that? That brings us to the layered scaling model.
Yeah, the research really confirms this long-standing philosophy. L1 is for security and settlement, while the layer 2s, the roll-ups, that's where the high-throughput action happens.
And we should probably mention the foundation laid by the 2025 Fusaka upgrade, which brought in PeerDAS, peer data availability sampling. Why was that so important for where L2s are heading in 2026?
PeerDAS basically solved the data bottleneck and massively reduced the bandwidth L2s need to post their data back to L1.
Got it.
Before PeerDAS, L2s were kind of stuck, constrained by L1's data capacity. Now they have this wide, cheap highway, and the One More Money blog projects that because of this, ZK rollups will probably dominate the space in 2026.
Why ZK rollup specifically?
Because they offer faster finality and lower proving costs, which for an institution, that certainty is everything.
So you have a scalable L1 from Glamsterdam and Hegota, plus optimized L2s powered by PeerDAS. That really does position Ethereum as the settlement layer for almost everything. And this is all happening just as institutional capital is really starting to arrive.
And that capital is substantial. A key event the analysis points to was the regulatory approval for spot Ethereum ETFs back in 2025. That just drove massive tangible net inflows. It turned theoretical demand into regulated, measurable capital.
And these institutions aren't just buying ETH to sit on it. They're choosing Ethereum for its utility and, of course, for staking generating yield. Which brings us to tokenized real-world assets, or RWAs.
RWAs are arguably the biggest near-term institutional catalyst. The research notes Ethereum is hosting a growing share of these money market funds, bonds. It's really integrating traditional finance with on-chain settlement.
And this is more than just putting a digital sticker on an old asset, right? It's about programmable compliance.
Exactly. When these assets settle on Ethereum, they can operate 24/7. And you can embed compliance rules like only whitelisted addresses can hold this bond. That's essential for legal enforceability.
And all this institutional activity feeds back into network security.
It does. The research noted that as of late 2025, something like 29% of all ETH was staked. That locks up supply and secures the entire network.
That security is a perfect transition to tokenomics, because unlike Bitcoin, Ethereum's supply is, as the blog puts it, explicitly usage-driven.
That's the defining feature. Proof of stake already drastically cut the annual issuance of new ETH compared to the old proof of work system.
And pushing against that issuance is the EIP 15559 fee burn. It permanently removes ETH from circulation by burning the base fee in every transaction. So when activity is high, you can get these net deflationary periods.
And this is a critical nuance the blog highlights that I think every investor needs to get. The success of layer 2s creates a bit of a paradox.
A paradox? How so?
Well, L2s are great for scaling because they execute transactions off the mainnet. So when a lot of volume moves to L2s, the amount of ETH being burned on L1, that base fee, can actually go down for a while.
So more L2 usage could temporarily slow the burn rate?
It could. It means that during periods of huge L2 success, the net issuance of ETH might actually increase slightly as the validated rewards become larger than the reduced burn. The system scarcity is a dynamic dial, not a fixed switch.
Okay, that's a really important point. So with the tech in place and the capital flowing in, what are institutions actually doing on Ethereum in 2026?
Well, we're seeing three main enterprise-grade use cases take hold. First, tokenized finance, like we just talked about, traditional assets settling 2047. Second, stablecoin settlement. Stablecoins are just dominating for cross-border real-time value transfer. Ethereum is becoming the global ledger for private money.
And the third one, which feels a bit more forward-looking, is decentralized identity and compliance.
Yes. We're starting to see emerging AML and KYC frameworks built on Ethereum that allow for secure, auditable enterprise workflows. The big caveat from the research, though, is that this all still hinges on getting robust regulatory frameworks in place to ensure legal enforceability.
Okay, now let's switch gears completely. Let's talk about what the research calls the non-consensus optional upside. I'm talking about the decentralized AI narrative.
And we really need to put a big asterisk here.
Yeah.
The blog is very clear. This is a non-consensus research narrative. It is absolutely not an official Ethereum Foundation plan.
So this is pure speculation.
You have to view it as long-dated optional upside for the ecosystem. It's a what if.
Understood. But the concept itself is really compelling. Ethereum as the backbone for a decentralized AI economy, maybe even a world AI coordinator. What makes Ethereum a candidate for that?
It comes down to the trust primitives. AI agents need deterministic execution and censorship-resistant settlement to interact economically. If you have AIs paying other AIs for services, they need a final, verifiable ledger that no single company can shut down.
A neutral playing field for machines.
Exactly. Ethereum's design, plus its maturing zero-knowledge proof ecosystem, makes it a plausible environment for these kinds of trust-minimized machine-to-machine interactions.
And there's already some technical exploration here, like the draft proposal for ERC-8004 trustless agents.
Right. That draft standard is looking at a framework for agent identity and reputation on-chain. It shows there's serious developer interest. But again, we have to stress it's a draft. It's not on the confirmed protocol roadmap.
And the role of zero-knowledge proofs in all this?
The idea is they could be used to verify that an AI did a complex computation correctly, like training a model, without revealing the secret data or the model itself. But the research is quick to note that doing this at a commercial scale is still incredibly challenging and largely unproven.
So what's the takeaway for the listener?
Treat the DAI thesis as a fascinating, long-dated call option. It's not essential to the core investment case, which is still firmly anchored in that institutional adoption and scalability roadmap.
Which is a good reminder to keep a balanced view and talk about the risks. These plans are ambitious, and the research points out some major challenges.
For sure. The number one risk is just execution risk. Implementing changes like ePBS and Verkle Trees on a live multi-billion-dollar network is extremely difficult. There's real technical uncertainty there.
And then there's the big one, regulatory uncertainty, how digital assets are classified, custody rules, and you can bet anything linked to AI is going to attract a lot of scrutiny.
And you can't ignore competition. The market is not standing still. High-throughput chains like Solana or other L1s will keep competing for developers and capital. And then there's the problem of liquidity fragmentation, with capital being spread thin across dozens of different L2s.
So let's pull all these threads together. The tech roadmap, the institutional capital, the complex tokenomics, and all the risks. What's the balanced investment thesis for Ethereum heading into 2026?
I think the core structural positives are very strong. It's positioning itself as the secure settlement layer. Institutional inflows from ETFs and RWAs are providing a stabilizing floor. And the usage-driven tokenomics reinforce scarcity over time.
But you have to weigh that against the challenges.
Absolutely. You weigh it against the high execution risk, the regulatory hurdles, and its dependence on the L2 ecosystem flourishing. So overall, what Ethereum offers is exposure to decentralized settlement infrastructure, but with a very realistic balance between the technological promise and the very real material challenges ahead.
That's the kind of clear-eyed view we came here for. So before we wrap up, here's a final provocative thought from the material for you to consider. Given that Ethereum's deflationary pressure is fundamentally usage-driven, how might the success of Layer 2s, which, remember, are designed to lower mainnet fees, how might that actually impact the overall scarcity narrative in the long term? We do have to provide the standard disclaimer from the One More Money blog. This article is for educational purposes only and does not constitute investment advice. Investors should conduct their own due diligence before making any financial decisions. We are not responsible for any investment losses incurred based on the information provided in this article. Thank you so much for tuning in. If you're interested in deep dives on cryptocurrencies, Ethereum, RWA, DeFi, and Bitcoin investment, make sure you subscribe to the One More Bitcoin channel so you don't miss our next analysis.
And please like and comment on this video. We really want to hear your thoughts on Ethereum's 2026 outlook.
Thank you for watching again. See you in the next deep dive about blockchain, Bitcoin, and crypto.